How's it going, guys? I'm Joe, and this is something they probably should have taught you in school. So recently, understandably, a lot of people have been seeing headlines about how the stock market is making all-time highs. Stocks are doing great. Meanwhile, they look around, and in their communities, the economy kind of sucks. Businesses are closing down, restaurants are never reopening. How can this possibly be? Now, I want to be clear. I'm going to try and explain my theory why this is, but hindsight is always 20/20. I don't have some kind of magic crystal ball. I certainly can't look forward and predict what's going to happen. It's just going to be my analysis and explanation of why I think the stock market has been so high when the economy objectively has been so crappy. The first thing I want to point out is this is not a new phenomenon. This has happened many times before. It will happen again. I want to read a couple excerpts from a book as an example. It's called The Great Depression Diary. This was written by a lawyer back during the Great Depression. I think it's going to seem eerily similar. So first is an entry from August 20th, 1932. This was after the bottom in the Great Depression on the market, which was around July 32. So this was in August. He said, "The speculative interest of the public seems as strong as ever in spite of their experience of 1929, which was the crash. Most of them seem determined to recover part of their losses. Both commodity prices and the bond market are also moving up. In the meanwhile, there is no visible sign of improvement in businesses or industry, and on the contrary, it seems to be getting worse. The situation is hard to explain." Another entry from September 1st. "The stock market, on the contrary, tripled its value during August in one of the quickest climbs I've ever seen. I believe this has also established a record. Nobody seems to know even yet why the stock market went up because business has gotten worse instead of better." And finally, an example from September 19th. "In spite of the activity in the stock market, business conditions get worse. Steel mills operate at 15% capacity. There is a slight increase in fall business, but it is probably only seasonal. The national elections begin to warm up. After a rising stock market of 6 weeks, which increased values 150%, the market broke badly last week. Stock prices are still 100% higher than last July and seem to me too high in view of present tremendous losses to all business. It is impossible to tell if the improvement is permanent or only an election market. So far in the last 2 years, the stock market has made 8 fake starts upward and then eventually came back to record lows. Commodities have also steadily declined and show no definite sign of upward return." So yeah, especially that last one definitely could have been written today, especially with the whole election. It's eerily similar. And again, remember, these excerpts were taken after the bottom was in, so it just kept going up even though things were apparently looking worse. So let's get into my explanation of why this could have happened. The first, most important thing I want to point out is the stock market is not the economy. Let me say that again. The stock market is not the economy. Another extremely important thing to start out understanding is what exactly you or the media and everyone means when they say the stock market. Most of the time when people talk about the market, they're talking about the major stock indexes. So that's the S&P 500 or the Dow Jones. The S&P 500 is made up of 500 of the largest companies in the United States, and the Dow Jones is made up of about 30 very large companies. I personally think the S&P 500 is a way better index and more representative of the overall US stock market because it has more in there and it's more balanced. So for me personally, if I'm talking about the stock market, I'm usually personally referring to the S&P 500, not the Dow Jones. So I ask you to consider this. With the whole coronavirus, yes, there have been tons of businesses, small businesses all over the country that are failing in record numbers. However, the biggest companies who are worth hundreds of billions of dollars with billions of dollars in cash, they are not failing. And that's simply because they have enough resources to weather the storm. So what do you think is going to happen when things start to return to normal and the biggest corporations, all who are part of the S&P 500 with billions in resources, they're going to now survive with less competition on the other end because everything else failed. So as much as it sucks for small businesses, these big businesses are probably going to be ending up doing better after this is over. But that's not the only thing. There are other factors. For example, interest rates have been cut to 0%. That means that these big giant corporations can borrow money, lots of money, extremely cheaply with very little interest. And this includes selling corporate bonds also at low interest rates because the prime market rate is so low. So basically, these companies now have access to more cash than ever to use in their business enterprises for cheaper than ever. Not only that though, but the Federal Reserve said that they would start buying corporate bonds, which increases the confidence in those bonds, meaning it's easier for these big corporations to sell those bonds. Another extremely important factor is with interest rates being so low, bond rates and bond yields are also low. And it's important to understand that institutional money, huge swaths of money, very rich people, very rich companies, they have to put their money somewhere. Now, before, if bond yields were decent and at least keeping up with inflation, you could put your money into a treasury bond, which would pay a decent amount. At least you'd keep your money. It's very, very low risk. But with bond yields being basically 0% in some cases, then that's not really an option because you'll just see your money fade away because of inflation. So a consequence of that is a lot of this huge institutional money has to go into stocks, which then pushes up the prices. And which stocks are they going to put this into? Of course, the biggest, safest ones. So let's add all this together. You have the stock market, which is made up of index funds, which are basically made up of just the biggest companies. These big corporations are doing fine in the sense that they're probably not going to fail anytime soon. And on the other side of this whole thing, they may even come out even better than before. Third factor is money is cheap to borrow. And fourth factor is stocks are one of the few places that huge institutional money can put their money to actually get a return above inflation. So with all those considered, is it really a surprise that people are willing to put more and more money into these big companies and drive up the market? Another huge misunderstanding though, and part of the puzzle, is not all stocks are doing well. You see, the S&P 500, yes, as an average is up, but it's a weighted average. There are companies in there like bank stocks that are doing absolutely horribly. I mean, look at Wells Fargo. It just tanked and has not yet recovered. Also, you have travel stocks like Wynn Resorts, way down, still down 30% since January. And then you look at something like the NASDAQ 100 index. Why is that up so much more even than the S&P 500? Well, it's mostly made of tech stocks. And obviously tech stocks are going to be way less affected by the coronavirus because most of them are using digital. People can use their products from home. People are spending same amount on technology, all that sort of stuff. And in fact, even the S&P 500 has a huge weighting of tech stocks, which is basically carrying it up because usually the bigger the company, the more it's weighted in the index. And obviously these tech stocks are some of the biggest companies right now. So they're kind of carrying up the average, even though there's plenty of other stocks in the S&P 500 that are not doing well. So I would think it's much better to not think of it as the stock market, but instead think of it as a market of stocks. If you look at which stocks are up and which are down, there should be absolutely zero surprise because tech stocks, ones that have been doing really well, are not really affected by the coronavirus. People work from home, still use their products. Travel stocks, hospitality stocks, where people have to actually go to places, interact with other people, those are obviously still down. So it's basically just that the averages, the indexes, are being carried up by tech stocks and other companies that are doing well, are not affected, and are going to be doing even better at the end of this. And the reason it seems like, oh, all these companies are doing so well is because everyone's just focusing on the ones that are doing well, and it's really just them. It's kind of a small proportion of them. So basically, that's just all something to consider when you see how the headlines are talking about the stock market doing better than ever. You might think it's not fair because so many businesses are closing. Well, this kind of explains it. So yeah, be sure to subscribe, guys. I'm going to be making more videos like this about stuff you probably should have learned in school, but they didn't bother teaching you. If you guys want to keep watching, the next video I would recommend is one where I was talking about why investing is not optional and why you're probably investing without realizing it in other ways, so to speak. So definitely click that video and check it out. I'll see you in the next video.